All right, everybody, welcome to the live stream. Okay, so how is everybody doing? And tonight we're going to have a great session on option strategy. Okay, so this is something that I've been wanting to do, and that's basically to share with everybody the basics of options, right? So before I start, just want to make sure that everyone can hear me loud and clear, right? So if you guys can hear me loud and clearly, type in the chat. Actually, the question, I have one question for all of you. The question is this: what is your favorite option strategy? Do you have one? Okay. All right. So everyone, you can type in the chat. What is your favorite option strategy? Okay. All right. Let's see. Let's see who is here. Okay. I do see some of you here already. Okay. All right. Hi, John. Hi, Christine. Okay. Good to see you guys. All right. So tonight I want to go through the basics of options, and I want to share with you guys that one strategy that I really like, okay, that I think is going to be very useful, right, and very powerful for many of you here. Okay. All right. Okay. So Kelvin is here as well. Hello. Hello. Okay. Let me do some setting change, because I can't really see some of the settings here. Okay. Just give me a moment, Oi, where did he go? Interesting. Yeah. Okay, come. Let me share my screen, then we can get started over here. Okay, okay. I can see it right now. Okay, so the question is this. The question is here. Okay, so what is your favorite option strategy? Okay, type in the chat. What is your favorite option strategy? Okay. All right. Okay, so let's see how many of you are here, and I want to see your reply as well. All right. Hi, Kelvin. Hello. Okay. So I think for many people, your introductory to options is probably the single-legged options, right? So it involves simple things like, buying call options, buying put options, okay? And today I also want to touch on single-leg options, but I also want to bring you guys to a slightly higher level, right? To help you advance, not just learning the basics of options, but this particular option strategy that I like to use a lot, especially in the current environment, whereby there's still a bit of uncertainty going on. Okay. All right. Now let's talk about a bit of current news first before we dive into the strategy, right? So what is the latest news as of right now? Okay. So by the way, just a quick disclaimer: everything that I share here is really 100% sharing and education. Okay, it's not meant to be any form of investment advice, right? So please seek your own advice, and please make sure to not take this as a recommendation or anything. Okay. Now, the first thing is the good news, okay, that we have is that Donald Trump, right, not himself, but Donald Trump finally is going to send someone, which is Scott Bassett, right, to meet with China in a very neutral ground of Switzerland, okay? And this is something that we've been waiting for. I really hope that they can, really come together and do a deal, right? When he announced that earlier on, he was going to have a super deal on the next day, 10 a.m., right? For a moment in my heart, I was hoping that is him. Okay. All right. I was hoping that is China. Okay. But of course it is not China. I think right now, many of you would already be aware. Wait, some of you say I'm lagging, is it? Let me see. Let me just double check. Oh dear, this has been happening since last session. I don't know if it's still ongoing. Let me just double check, okay? Okay, I think it's fine. I can hear myself. Okay, I can hear myself. All right. So yes, they're gonna have a deal with the UK. It's not the best country in terms of deal. I was hoping it's either India or China. But hey, as an investor in the US stock market, I will take it, right? Whatever good deal, whatever good news there is, I will take it. Okay. All right. So this week is quite interesting because yesterday we just had the FOMC meeting, okay? And today we're going to have a few more earnings, and we're going to have Shopify, right? Shopify earnings as well, Coinbase earnings as well. By the way, guys, y'all can get this earnings calendar, right, delivered straight to you, right? If you had the Moomoo app, right? So they actually send this to anyone that has a Moomoo app, and you can download this and have a look, okay? But why I particularly mention about Coinbase and Mara is that I'm not sure if you're aware right now, Bitcoin is actually at a very, very interesting level. Okay, so over here, let's take a look at Bitcoin. So if I were to go to Bitcoin, all right, so you can see right now as we are talking, Bitcoin is reaching 99,345. I'm going to zoom in a bit, okay? Right, you can see, oh, the number is here, right? 99,340, right? So it's still fluctuating, it's fluctuating, but the trend here looks really promising, right? It looks like quite a decent uptrend that's happening right now, okay? And which is why tonight, in terms of earnings, I think for Coinbase and Mara is likely going to be quite significant, right? Quite significant for them because they are heavily influenced by the prices of cryptocurrency over here. Okay, all right. So I want to talk about options right now. Okay, so later if you have more questions about cryptocurrency, Bitcoin, we can talk about that later on. But right now I want to go into tonight's topic, which is how do you make gains, right, in this current environment using options. Okay, and over here you can see that, okay, I'm just going to hide the names first because I don't want you to focus on what company it is. Okay, it's not meant to be copying, but the idea is that if you're right now is one of the best time, right, in my opinion, one of the best time to be using option as a strategy. Okay, because right now the volatility is very high, right? The volatility. So when there's high volatility, it means there's going to be very, very high premium. Okay, so you can see over here for this one, I sold in April, expiring in April 25th, right? 2 contracts, right? The total is going to be about 500 plus. Okay, and this was also same expiry date. 3 contracts is a bit lesser, and that's because I put the strike price very far away. Okay, and then if you put your strike price closer, you're going to get much more premium. So overall, just based on this four trades, right? I think how much did I make? About 1,600. So it is really quite rich right now for people who are selling options, right? You can get really solid premium. That's why I want to share with you guys how to do it, okay, today. Now, number one, the first thing that I want you all to learn, right, which is also one of my favorite strategy, is actually selling a put options over here. Okay, so over here you can see that what does selling a put option mean? It means you are agreeing to buy a stock. Okay, so this is basically options 101. For those of you who already understand selling put options, take this as a revision. For those of you who are absolutely new, right, just remember in the options world, there are 2 types of options. Okay, there's going to be a call option, there's going to be a put option. Now, for simplicity's sake, tonight I'm going to focus on just put options. Even the advanced strategy is just put option. Okay, so what is a put option? So basically, when you are selling a put option, which is what I did earlier on, okay, all this you see are minus, all the minus, right, is basically me selling options, and in particular, I am selling put options. Okay, now why do I do that? Because when I sell a put option, I'm agreeing to buy a stock at a specific price. Okay, and because I'm doing that, right, in a way, I'm kind of selling insurance, right? Think about it. I am promising to buy a certain stock. So let's say the stock price is trading at 140, okay? And if I sell a put option with a specific price, right? So let's say I put it at 130, okay? And usually we call this the strike price, okay? I am promising to buy 130. So in a way, I am insuring the guy who has a stock that no matter what happens, don't worry, I will buy your stock at $130, okay? And as an insurer, when you are giving insurance, right, guess what? The insurance company are super lucrative. Okay? And this is one of the opportunity that you can be an insurer. Okay. So by giving this insurance to the holder of the stock that you will buy them at 130, okay, they will have to pay you a premium over here. Okay. So this is essentially what it is, what I did in the previous slide, right? All these basically I'm promising people, I will buy your share at 292, I will buy your share at 305, I'll buy your share at 300, so on and so forth. Okay, right? So this is actually my main go-to strategy. Okay, but this is not the main strategy I'll talk about later. I'll share. This is the basic one. It's just one simple selling put options. Okay, now how does this work? Okay, so there are 4 parts to selling put options. Okay, so this is like options 101, right? These are options 101. Number 1, you as the put option seller, you are agreeing to buy the underlying stock or they put asset over here at the strike price. Okay. Should the person who buys your put, right, choose to exercise it, right? And by doing that, you will receive a premium. That means the seller will have to pay you some money to buy that insurance from you. Okay. So there are two types of scenario that can happen. Okay. So I see some of you, like Kelvin and Vincent, you're already asking some questions like, hey, do you sell at the money? How long's the duration? Don't worry. Hold your horses. I'm going to go through that as well. Okay. But I want to go through the basics first to make sure that everyone here understands what exactly selling put option is. Because if you don't understand the basics, okay, you might end up chasing the put options premium, right, without actually knowing what is the danger here, right? So it's very important, right? Recently, we just had the Berkshire Hathaway meeting, and Warren Buffett once again emphasized the importance, right, of safety. And this is what I want to do here is to make sure that all of you here are investing or even trading, right, in a very safe way. Okay, so now let's come back to here. Once you sold a put option, right? So let's say we go back to the just on the analogy, $140, right? Let's say this is your strike price. That means you promise to buy $140. Okay, there's going to be two scenarios. Scenario number one is that at the expiry date, okay, let's assume the expiry date is here. Maybe I wouldn't say how long now. Maybe the expiry date is here. Okay, right. Later I'll tell you about the expiry date. You can choose. Okay, if the price is below, right? Let's say the price drops below 140. Let's say it's 130. Okay, right. So basically, you are obligated to buy the asset at which price? Is it 130 or 140? Type in the chat. Is it 130 or 140? Now that the share price dropped to 130, but you promised to buy at 140, right? Okay. Yes, the answer is 140 because that's what you promised. Okay. So that is scenario number one. Now, scenario number two, if, okay, let me just draw this again. If you sold a put option with the strike price of 140, right? And at the expiry date over here, for example, the share price went up, okay? Then in this case, you will not be asked to buy the shares at 140 because let's say it went up to 150, right? So the holder of the share could just sell the share to the market at 150. Yeah, he wouldn't ask you to buy 140. So in this case, the option would have expired without being exercised. So you get to keep the premium. Now, one important thing is that even in the first scenario whereby the market price is lower, you as a seller will always keep the premium, right? So this is like if you're buying a travel insurance, okay? And let's say you lost your bag, okay? Does the company actually return you your premium on top of what they compensate you? No, right? The premium of the travel insurance still goes to the insurer. So in this case, even in the first scenario, you will still keep your premium, okay? And this is important. Later we'll go into why this is crucial because it can actually lower your entry price over here. Okay. Now, this is the basics of how do you sell options and gain a source of income, right? So right now, the market has been coming down for close to, I think how many days? Close to 60 days, really. Right? It started in 30 days, sorry. It started in 2nd April, right? Okay, so now it's almost 1 month into it. And I've been selling premium after premium after premium. Okay, right? So this is what it will look like, okay, when you sell a put option. Now, this is what we call an option profit graph. Okay, later I can use other websites to show you guys, but basically, this is what it means. Okay, and in this case, okay, let me just orientate you guys. What the person did is that he sold a put option with a strike price. That means he promised to buy at $380. Okay, and you can see over here the break-even price. Okay, is actually not 380. It is 368. Now, why is that the case? Since he promised to buy at 380, why is the break-even actually lower? Okay, yes, and the reason is because he sold the option for $12. Okay, you can see over here, right? In fact, they also write it over here. The options premium is $12. So when you promise to buy something at 380, but you already collected the premium, okay? And just take note, you collect the premium, okay, upfront, right? That means you collect it right at the beginning, not at the end. The moment you sold the insurance, right, you collect the premium already, okay, right? So that's why even if the share price drops a little bit below 380, even if it drops to 370, are you still in the profitable zone? The answer is yes, okay, because your effective purchase price of this share is actually only 368. Okay, so basically anything above 380, you will make full profit, right? And you will keep the full $12, right? Which is this blue zone. But if the share price were to drop, okay, and let's say it drops all the way down, let's say this is $200, then you stand to make a big loss as well, right? Because the difference here is between 380, right? Between here and here, 380 and 120, that is $180, okay? And this is kind of like the scary part of selling put options, okay? Because when you are selling put options, a lot of times, if the share price fall down a lot, that's where you will really see a big problem, right? You will have significant losses over here, okay? All right. So let me give you an example over here. Let's say Google share price. I took this yesterday, so today will be lower already because Google had a bad day. Okay, Google fell by I think 3-4% or something like that. Okay, so but let's look at the price over here. Google is at $162. Okay, let's just ignore the decimal point, right? So when you sell a put option, just remember each put option represents 100 shares. Okay, 100 shares. So if you are being exercised, the person say, hey, I'm going to ask you to buy over my shares, right? Okay, how much fund would you actually need? Okay, so you take 162.75 times 100. So your funds that you need is actually quite significant. It's 16,275. Okay, so this brings me to my first point is that when you want to sell a put option, okay, make sure you sell it on a company that is already selling pretty cheap, and it should be a very strong business. Okay, why is that important? Because if it's a very strong business, then the chance of the share price falling from say 380 all the way down to 200 is a lot lesser. Okay, and why it should be a strong business is also because why it should be cheap already, because if it's already quite cheap, the chances of it falling down deeper is also less. Okay, it is also less, right? So these are some of the challenges that you will face when you are selling put options. Even though, to be frank, for those of you who have bigger portfolios, actually selling puts right now in this current environment is my favorite. Okay, because I can gain maximum premium over here. Okay, so you will need larger funds to achieve, right? To sell put options, or in fact, if you want to sell call options as well. But today we just focus on selling puts. Okay, and there's a larger potential loss during a volatile market over here. Now, to show you how lucrative it is, okay, let me just come back here to the Moomoo platform, right? And let's just use an example. Okay, so let's say I go to maybe Google. Okay, Google right now, since Google fell by so much, right? Maybe it's already cheaper, okay, right? Okay, and I'll go to the options tab over here. All right, okay. So you can see over here, if I were to sell maybe I'll sell a June, right? So let me just scroll in here, make sure all of you can see. Okay, I'm going to sell a 6 June or June 6 put option. Okay, that will be 29 days. So the Moomoo platform is quite useful because they show you the number of days over here, right? And they show you the date as well, right? So you can, without doing mathematic gymnastics in your head, right? You immediately know, okay, this is going to expire in 28 days, right? The next one is going to expire in 36 days, right? So this is quite useful. Okay, so what I'll do is I'll look at the right side, which is put options over here. Okay, so you can see put options. Right now, the current Google price is 151. Okay, wow, Google fell by 7%. Interesting. Okay, so if I were to do a 39 days, let me just double check. 29 days, so that's about 1 month, right? Okay, right. If I were to sell a 140, okay, or in fact, if I want to be more cautious, maybe I sell a 135, right? You can see that even though I'm not even selling at the money, okay, I'm selling quite far out, right? I am getting quite good premium already. I'm getting 1.42. Okay. So in this case, I'm making a profit of $142. Right. So over here, just calculate your ROI very quickly, right? So let me bring out my calculator. Okay. So over here, just calculate for yourself. 142. Okay. Divide by the total price. So it's 135, right? So maybe I'll just delete this again. 1.42. Wait. 1.42. Okay, divide by 135, right? So I'm getting 1%, 1% for 1 month. And even though I'm selling so far away, okay, right? I'm selling so far away. is 150 now. I'm selling 135. It is a huge discount. It is close to a 10% discount, right? And I still can get 1%, right? So this is the benefit. Now, for those of you who say, hey, Pete, I've been wanting to accumulate Google shares, and I think right now Google shares are quite cheap, then what can I do? Let's say, okay, if I want to buy Google shares already at 151, what I would personally do is I'll just go ahead and sell put at 150, okay? And you can see over here, the selling price is $5.10, right? So how much ROI is that? Let's bring our calculator again, okay? So in this case, okay, 5.1 divided by 150. It is 3.4%, everyone. It is 3.4%, and it's not on a speculative business or whatnot. It is a serious business called Google, okay? Right? And this is what I meant by right now, the volatility is very high because everyone thinks that the market is going to crash and whatnot, okay? So later we can talk more about why I think we are in the recovery phase already. Okay, we might be seeing a little bit of pullback here and there, but overall, I think we are over. We have what was the phrase called? We have gone through the tunnel already. Okay, we are looking at the light at the end of the tunnel already. We are reaching there already. Okay, so right now the premium is very, very rich, right? Which is what I love, especially for stocks that are really solid like Google, because you can actually look at the financials over here at Moomoo as well, right? So you can see the key indicators, right? For the latest earnings, right? Let me just zoom in here. Okay. For the latest earnings, can you see the ROIC, ROE, ROA is still very, very strong. Very, very strong. It's ridiculous. Okay. If you look at the income statement, okay, so this is meant to be an option class, but end up it become like me talking about Google already. Okay. But I just want to show you how do you invest in this environment, right? Where there's a lot of fear. Okay. So for example, you look at the latest one, Q1, right? And Moomoo already updated it, right? The total revenue went up by 12% year on year. Okay. The net income. Okay, so let me scroll down to net income. Okay. Over here, right? The net income is 34 billion. Okay, so it's a bit lesser than the previous one, but really, if you compare it year on year, previously it was always 20 plus million. So actually, it went up by like 45%, you know. 45% increase in earnings. Okay. But of course, the market didn't like it because there was a lot of change in their projection. You know, they are being a bit more conservative. And, you know, they say there's an influence of tariff and AI and whatnot. So really, they are giving themselves, the management are giving themselves a lot of leeway, right? In case things were to fail. Okay. So that was what made the market very bearish on it. Okay. But even when you look at the cash flow, right? You look at the cash flow from operating income is 36 billion. In fact, the cash flow from operating income and the net income is actually about the same. Right? So this is a very, very cash flow heavy business, which I love. Okay? Right? So this is the type of business that I would really like to, sell put and buy the shares because I will have almost no downside. Okay? But what is the challenge here is that when you sell a put option, right? So let's say for Google now it's 151, right? You will need $15,000 to fulfill the put options. Okay. All right. Now, of course, guys, you can actually sell a put option without having the funds. Okay. Let's just be very honest here. You can do that, but I don't encourage that because should you need to purchase it and you don't have the funds, right? Then you will go into this situation called margin call, which is a very bad situation because the brokerage might be forced to liquidate some of your other position in order to cover this. Right, so that's not what we want to achieve here. So always remember what Warren Buffett says, right? Okay, I don't know whether he said it, but I always associate this quote to him is that if you take care of the downside, the upside will take care of itself. Okay, all right. So, but today I want to share with you guys what if, right? You want to invest selling puts, but you don't have that much funds, right? You want to do it with a lesser amount of money. Okay, and this is where I bring in this concept called the bull put spread. Okay, the bull put spread. Now, bull put spread is known as a credit spread. You can Google this online. It's very easy to find, right? So today I want to go through with you guys a 101 on what is a bull put spread. But more importantly, I will also share with you what are my personal trading parameters. Okay, so this one you may find may not find it online, but you can find different variation. Basically, everyone, right, trades with their own set of parameters. Okay, everyone has their own ways of trading. Some people use different durations, some people use different take profit target. But this is what worked for me, and I wanted to share with you guys very openly. But once again, guys, remember, this is just my own parameters. By no means should you copy this, should you follow this. But I want to use this as a form of education, because all these parameters that I thought through, right, there's a reason behind it. Okay, so later I will show you what it is. Okay, so let's go through the basics of bull put spread first. Okay, so what exactly is a bull put spread? Okay, so let's break it down into the words. Bull means this position will tend to make a profit, right? Should the share price be bullish, that means it's heading upwards. Okay, and it's using two put option. That's why it's called bull put. Okay, and why is it called a spread? Is because you are entering the two put option, okay, at different strike price. So there is a spread, right, between one and the other put option. Okay, so over here, once again, let's use Google again, right? Right now, let's say we already know the share price fell down to 151, right? Okay, so what can we do? Okay, so the easiest way is to ask yourself, oh, now the share price is at 151. Okay, where will be safe, right? Or where will be higher chance or lower chance that the share price can fall to? And that's where you want to set your first leg of the strategy, which is the usual standard sell put. Okay, and for example, over here, let's say I take this bottom part, right, at 140, which is the lowest it has come down, since the last 1 year, right? Okay, I will say, okay, I don't think the share price will fall through here. Okay, so that is the assumption that I have, right? So what I will do is that I will set a bull put spread that is just above 140, and then the other leg I will put it below 140. Okay, now don't worry, I haven't told you that what exactly am I going to do. Am I going to sell? Am I going to buy? Don't worry. But just remember, I'm setting this box or these two lines, right? Okay, as the spread. Okay, and the main idea is that I am betting that, okay, or I am assuming that the share price will not come into this zone and it will not break through this. That's why it's a bullish trade. I expect the share price to either head upwards, go sideways, or even maybe slightly down. That's why I put it so far away. Okay. Now, to give you all more context, right? How does a bull put spread work is this, okay? So just now, remember the first leg, what you all did was a sell put, right? So just now we sold the sell put. So let's say the Google one, okay? So now Google, the current price is about 150, okay? I'm going to do a sell put at, let's say, 145, okay? Right? And the next leg of it is that I'm going to do a buy put, right? Totally opposite. I'm doing a buy put, right? So maybe the buy put, I will do it at 140. Okay. So in this case, 140, 145, the spread here is $5, right? A difference of $5. So what am I assuming? And I'm assuming that the share price, okay, at 150 over here will not go below this. Okay. Right? It will not go below this. So you can see that where's my is that eraser? There's an eraser. I'll delete everything. Yeah, I don't want. Okay. So you can see the chart over here at 150, correct? If the share price stays above my 145, actually, I will collect the full premium. Okay. But even if the share price were to drop below and drops all the way, let's assume that it drops all the way to 100. Now, how much will I lose? Can everyone type in the chat? How much will I lose in this case? Okay, so Kelvin says the buy put needs 100 shares. Is it? Okay, and the answer is no. Right? So guys, you do not need to buy 100 shares to do the buy put. Don't need to. Okay, all right, don't need to. Okay, so can you tell me if the share price drop all the way to 100 does it mean that I will lose a lot of money? Like let's say my current is 145, drop to 100 means what? Wow, $45 difference. Does it mean that I have to pay 4,500? No, okay. It is only $500. Yeah, okay. Yeah, Vincent got it. Fantastic. Okay. It is only $500. Now, why is that the case? Why is it $500? That's because you bought an insurance. Okay, so remember just now you said selling put is a selling insurance, right? When you bought a put, you actually buy an insurance. So in this case, you are buying an insurance at 140. That means no matter how far the share price were to fall, okay, no matter how far it falls, doesn't matter, okay, it has nothing to do with you. Okay, your maximum loss will be just the difference between the buy put and the sell put, which in this case is $5. right? So actually the margin required when you do a spread, right, is also just $500. Compared to just now, if I were to just sell put at 145, my requirement will be 145, then what? Add to 0 because 100 shares, right? So you can see the requirement difference is significant, right? So this is 14,500, this is just $500, right? Which is why I also like to share bull put spread with novice, right? With new investors who are having a smaller portfolio, because this is where you can really, kind of test out the market, have a go at it, give it a try and figure out, what kind of investing suits you at very low cost. Okay? At really, really low cost over here. All right? Okay. So this is a bull put spread, right? So for example, right, if you are on the Moomoo mobile platform, it's very useful. They give you all the information you need, right? So for example, back then, I look at Google was 162, right? So I set it a bit further, right? So I say, okay, I'm going to do a sell put at 155, right? I'm going to do a buy put at 150, right? So can you see here? Sell 155, and then the buy is at 150. So my spread here is $5. Okay? Now, here comes the interesting part, is where you need to decide whether is it worth it or not. Okay? So over here, you can see that the premium that I'm collecting is right here, right? So Moomoo already calculated for me. It says my max profit is $101. That means the premium I'm collecting is 101. Now, remember, the spread is 5. So my max loss is $500. Okay? Right? But why is my max loss here $399 instead? Because Moomoo already pre-calculated, right? From $500, they minus away 101, right? So your max loss is actually $399. Okay, so remember this, even if the share price was to pierce through 150 all the way, bam, okay, you won't lose 500 because you would have collected the premium upfront. And this is actually one of the best scenario, okay, because I chose this to show you my own personal parameters. Later, I will put it on the slide so you can copy down again, okay? But my own parameters is that for every $5 spread, right? For every $5 spread, I want to collect at least $1, right? So for every $5 I put on risk, I want to collect $1. So for every $500 I put at risk, I want to at least have the profit of $1. Okay? So this is important. That means my expected return here is $1 out of every $100 for every $500. Okay? All right. Let's see if you've got any questions. Right. So Kelvin said this strategy needs margin for 100 shares. No, don't need. You just need it for the spread. So in this case, the spread is $5, and then you just times 100 over here. Okay. All right. Okay. So Ziyi asked a great question. What time frame do we choose? Right. Later I'll go through all these with you. Okay. So you can see over here, I chose a expiry date of 46 days. Right. Not the usual sell put where you can choose very short-term duration, like 7 days, 10 days, right? And there's a good reason for it. One is because when I look at other platform, right, where they do a lot of back testing, right, they realize that the ideal case here, okay, the ideal case here is between 40 days to about 50 days. Okay, later I'll show you how to manage it, but just remember this magic number first, between 40 to 50 days. Okay, all right. So this is just once again telling you how they calculate the max profit and the max loss. You can go and read it yourself on the Moomoo platform as well. Okay, but the good thing is that once you use the platform, right, they will just calculate everything for you. So you don't need to do too much homework. Okay, right? You just need to ask yourself, okay, my spread is $5. Am I getting $1 here? Am I getting $100? If I'm not getting $100, that means it doesn't fulfill the parameters that Pete is using. Okay, right? Okay, so these are my trading rules. Okay, so this is the part that onwards I want you to pay attention to. Okay, but once again, I purposely put the disclaimer below because this is really what has worked for me, right? I can't say that it will definitely work for everybody, right? So please use this as education first, right? And slowly figure out what are the parameters that suits you. Okay, because it is not just the parameters that matters, it is also whether you can execute the rules as well. Okay, so number one, my personal rule for doing credit spread, right, is that firstly, I need to find a support level first, right? So why is that the case? Because I want to know, hey, where will the price sort of, not go below in a way, right? Higher chance of it staying above this line, which is why, let's say I look at Google right now, the share price now is 150, 151, okay, right? I want to maybe choose about 140. This seems to be like a good support level, right? So my spread will be somewhere, using that as an in-between. So in this case, just now I choose 145 and also maybe 140. Okay, right? Now, I will choose roughly about 40 days to expiry. Okay, why 40 days? Because 40 days will give me some time, right? Other than the backtesting result, but when I do it, right, I also realize 40 days will give me some time for the share price to move in the direction that I think it should. Okay, so for example, when I did this Google 164, right, and now the share price, boom, 151. But if I have 40 days, I don't need to worry because so long eventually the share price hit upwards, I'm very safe. Okay, even if the share price were to come down to 145 momentarily at 140, and later on at the end of the day, right, reaches above that, then I'm safe as well. Okay, so I find that not just the backtesting works for me, but also when I did it myself, I find that around 40 days seems to be quite a sweet spot, right, for implementing a credit spread, right? Over here, like I said, we go for 20% profit to loss. So for every $5, right, I want to make sure that I can at least get $1 back. Yeah, right. If I win, I win $1. Okay, all right. Now, so why 40 days is really a balance between expiring as soon as possible, but also giving some time for the trade to work out. Because a lot of times, if you choose very, very short duration, right, what happens is for a spread, later on the share price go up, right, then you'll be like, oh no, right, I could have been profitable, right? So we want to avoid this situation over here. Okay, all right. So how do we manage the trade after you have entered it? Okay, so let's say I've already entered the trade. I put the spread somewhere here. Okay, now what am I going to do? Right. So there are various scenarios here. Let's go through one by one. Okay, if the market price is above, right, your break even. Now your break even is usually somewhere in the middle. Okay, your break even price is usually somewhere in the middle. So in fact, just now Mumu calculated already. I think if you can take a look. Okay, so over here, can you see? I sell put at 155, my buy put is at 150, right? Wow, Mumu super good. They just calculate for you, right? Break even 153.99. Okay, all right. So just remember this number when you sell your spread, so that you will have in mind, what is my break even price? Okay, right. So if it's above your break even, then no problem. Just let it expire because when it expires, you will be profitable. Okay, so that means actually Bull spread is not just profitable when it's bullish because I'm setting it so low, right? Of course, if the share price goes up, I am profitable. If the share price goes sideways, I'm also profitable. But even if the share price were to go down a little bit, so long it's not too much and doesn't breach my 140 plus mark, right? 143 maybe in this case. Let's say that my break even is 143. I will still be quite safe, right? So that's why I'm okay to use this position, use this trade even in this environment, because even with the uncertainty, I have a lot of safety built in already. Okay, but let's say, of course, we must always prepare ourselves, right? Should the market price goes below, right? So let's say the share price, okay, right, below 143, right? Okay. Now, there's a few things to consider. Look at your expiry date. That means how many days to expiry. Okay. So if it's less than 20 days to expiry, that means you have already burned through about half of the duration. Okay. What I will personally do is I will cut loss. That means I will close that position and take whatever loss there is and take a look at the trade and say, hey, maybe previously the support level that I saw wasn't really at a support, but now maybe it seems to be closer to a real support. And I might want to enter another trade. So I call that rolling to a later date. That means I close this spread. That means I close this up. I take a loss first, right? And then I open a one at the bottom, right? So here I will make a loss, right? Here will be negative, but here I will have a positive, right? So in a way, I will do again just to cover this. And of course, if I can cover totally, right, that will be the best. Okay, so that is if your date to expiry is less than 20 days. Okay, but what if, Pete, what if I have still more than 20 days, but the share price already fall below my break-even price? Then what I will do is I will just be patient and give the market more time, right? Because ultimately, why did we choose a date to expiry about 40 days around there, right? Or even when they do back testing, they say you can go up to 50 days. Is that we want to give more time for the trade to work out. Okay, so many times when I've been doing this trade, right, sometimes when there's big news, okay, the share price will tank a lot. But then later on, as the news kind of digested, the news kind of fade away, then guess what? The share price start to move out again. Okay, right? So if it's more than 20 days, let's say I'm at the 30 days to expiry, I will generally just leave it first. I will revisit it when it's coming closer to the 20 days, right? So I'll make a decision at the 20 days, 19 days, that kind of period. Okay, so this is what I will do, right? So this is how you should manage it. And basically, for all of you out there who aspire to be an options trader, right? This is what I would suggest you to at least have in your system of trading. That means you clearly set out your entry rules, okay, and you also set out your exit rules, so that before you even enter the trade, you already know that what is going to happen already. Okay, if scenario A happen, I'm going to do this. If scenario B happen, I'm going to do this. Right? There is nothing left to chance. Right? There's no ambiguity, because a lot of times I see what a lot of people did is that they will have the entry done up. Right? The entry will be done up very, very nicely, but they will not have the exit done up for themselves. So what happens is that when the situation goes a way that they don't want to, for example, the share price drop below the break even, they don't know how to react. Okay, so make sure you think of the possible scenarios before you enter the trade. All right, okay. So of course, other than when to exit, also another way to exit is, hey, maybe we can take a profit. Okay, so once again, the profitability is this. It's a very simple rule. It's either at the 20th day, if it's profitable, I will just close the position, because I actually don't want it to go below 20 days for too long. Okay, or I will reach the 50% mark, I will also take a profit. Okay, right? Whichever comes first. Okay, so for example, let's say I do a spread here. Okay, and the share price didn't go down, it just went up. Okay, so very soon, what will happen is that my sell put will start to make a profit, okay, to a point that it becomes 50% profitable already, right? If it happens that quickly, I will just be very happy to take the profit. Why? Because I wouldn't want to hold on to it for another 50%, because very likely it will take a very long time, the rest of the period, right? Let's say it takes 10 days to get to 50 days. That means 50%. That means I got another 30 days, before I make the other 50%, right? So that is a very long wait. So what I'll do is I'll just take this profit first. And if I see that the share price subsequently form a support level somewhere here, I will open the next one. Okay, so that is my trading philosophy. Don't be greedy. One that's good profit already, I don't want to waste time, right? I want to open the next trade. Okay, so depending on which one comes first. It's either you hit 20 days, then maybe you're at 30% profitability. I'll just take it as well. Okay, so whichever comes first. All right. Okay, so Kelvin says 3 months to 6 months safe. Okay, I find anything more than, let's say, 2 months, it's a bit too long already. It's a bit too long already, because when you're trading, right, guys, remember one thing is when personally now when I'm trading, right, the opportunity cost matters, right? So once the trade starts to move already and you're already in profit already, there's no point hanging on to the trade, especially in this scenario where there is a maximum upside. Okay, if it's an uncapped trade, that means the share price move up, you'll make even more, then by all means keep the trade, right? But for me, it doesn't make sense, because let's say I'm doing just now that trade, right? My maximum profit is only 101. Okay, so even if I were to hold on for dear life, it's not going to go above 101, right? So I won't do that. Okay, all right, I'll just take profit whenever it's 50%, or at the 20th day, I'll make a decision as well. Okay, all right, okay. So over here, okay, so let me show your, okay, so if you have any questions, can ask in the chat. Okay, so I hope I answered Zhiyi's question already. So Zhiyi was asking which time frame should we choose. So I generally choose about 40 days. Okay, choose about 40 days. And for Daniel, do we buy when IV is high or low? Very good question. Okay, so for example, right, if I go on to the Moomoo platform, okay, so let's choose, you see Google drop like crazy, right? Then suddenly now bouncing 1+%. So see, good company is like that. Okay, so let's come over here, right? Okay, so let's say I take the 43 days right now, okay? And I think Google is fairly cheap, right? So I'm going to zoom in here, okay? Right? And I want to sell, maybe let's say I want to sell 135, okay? Right? I want to sell 135. And then I want to buy, maybe I'll do a spread of, let's say, $5, right? So I'll buy a 107. Okay, right. So let me zoom out first, then you all can see it. Okay, let me zoom to the bottom. Okay, so this is a wrong one. Let me delete it. Okay, so you can see in this case, this trade won't be so lucrative, right? So over here, guys, can you all see? My spread is 5, but actually my max profitability, even if I were to push it all the way to this end, right, is only about 0.49. So this is a trade that I wouldn't take because, sorry, yeah, over here. Okay, it only is 0.49. So this is a trade that I personally wouldn't take because it doesn't make a lot of sense in terms of profitability. I'm risking 500 for $50 only, So it's like, it's not 5:1 already. It's just 10:1, which is too much, right? So this is not a trade that I'll do. Now, why is it giving me such low premium? Is because 135 is very far away from 155, okay? Right? But let's say if I were to delete this two, okay, right? And I choose something closer, let's say 145 and maybe 140. Okay, so you can see so you can see over here, yeah, then my premium now is a lot more acceptable. Okay, it's at 107, right? 107. Okay, right. Now, so in this case, to answer Daniel's question, should be high IV or low IV good for this? Why don't you all type your answer in the chat? Is high IV or low IV good for this? Okay, think about it. I am selling one option and I'm buying one. Okay, I'm selling the 145 one, I'm buying 141. So in this case, would volatility be good for me or bad for me? Okay. All right. Yeah, very good. Okay. So the answer is, sorry. Okay. So the answer is the volatility will be good for me because I'm selling a higher price insurance. I'm buying a lower price one. Okay. So even when volatility is high, right? Actually, this put spread usually does better in a higher volatility environment. Okay, quite a tongue twister there. Okay. All right. Okay. So Daniel, great question. Okay. All right. So this is what I will always do when I do spreads, and and in fact, if you are looking at doing spreads, Moomoo has a lot of things that they can help you with. For example, you can even look at your profitability diagram. Remember just now I told you, right? So in this case, this helps you to visualize, right? Let's say if I were to sell 145, buy 140, right? Okay, what is my profitability? Where's my break even? You can even see a break even here, right? 143.94, right? And the maximum that you will lose is over here, 396, right? So in fact, when you enter the trade, you just look below, right? Okay, they already keen for you already. Your max profit is 106.5, depending on the premium you choose. Okay, and your max loss is 380 something, right? So because now I haven't locked it in, so they keep jumping, right? But essentially, these two numbers add up, it should form $500, right? It will never be more than $500. Okay, so this is what I personally like to do, right? When I'm doing the trade, there I'll just toggle between the table and the curve just to have a sense. Sometimes visualization is much easier, right? To have a sense like, okay, what am I looking at here? Okay, right? What is happening over here? Okay. All right. And in fact, you can also do strategy builder, that you can actually do your spread straight away, right? So in Veggie, you can put bullish, then you can see that they will do short put spread, right? This is essentially what I was telling you guys, this one over here. Okay, so you can zoom in here to take a look. All right. So Moomoo has a lot of very interesting things that you can go and explore, but generally this is what the few things that I love about it is that you can look at the curve and also look at the table very easily, right? And you can also factor in like other things like, some of you here are very Greek focused, you want to know your delta or whatever, not right? It's over here. Okay. And in fact, just now, remember we talked about like, hey, Pete, if I sell a put options, right, what is my ROI? Do you remember that? Okay. So can you see over here, right? It's actually already calculated for you right at the end here. Right? It says seller ROI. That means if you were to sell this put option right now, okay, the ROI that you will receive for the amount of premium, for amount of strike price that you are promising to buy is how many percent? Right? So over here, this is 1.6, 2.3, 3.3. Right? So depending on what you want to do. Okay? Right? So this is the Moomoo platform over here. All right, so market is open already while Google is really recovering quite strong, quite nicely, right? Okay, so any questions? Let me see. Let Let me see. Okay, so Kelvin is asking choosing the time decay. Choosing time decay. So for selling put options, right? Even when you're doing a bull put spread, right? Okay. The time decay is actually not a big factor here. It is not a big factor. All right. So let's see if I can show you here. Okay. So guys, can you all see right over here at the bottom here? All right. Let me just hide Kelvin's question first so you can see better. Right. Okay. So you all can see over here there is a date slider. Can you see that? Okay. So you can see that even as I slide the slider, okay, the changes here is basically your profitability. Okay. So once again, we can also see the impact of the 20 days, right? So basically, if I'm anything before that, right? Okay. Actually, I can break even, right? It's actually higher. Before that is higher. Okay. Anything before that. But as the date goes closer and closer and closer and closer to expiry, that's where it slowly transforms into the solid line that you see. Okay. All right. So this is what it is happening. So in fact, if you look at it, right, actually time decay, is it good or bad for you? Think about it. Think about it. Time decay actually is it good or bad for you? Actually, it actually brings your break even, right, closer to a lower price. So actually time decay is good. And why is that the case? Because you are selling a higher premium. You are selling a put that is more expensive. So actually time decay is on your side. Okay, it's on your side. But the good news is that volatility, after you buy already, right, the higher the volatility, right, is also harder because you need to purchase back the put option. Okay, so about the onset doesn't matter, but later on if it shift, it does matter. Okay, all right. So let me move out here. Okay, a bit of geeky, a bit of like options geeky stuff, but I hope you all don't mind about that. Okay. Okay, Celine's question. When you roll, do you roll the whole set of 2 legs? Is there a situation you will work on 1 leg only? Okay, so no. Usually what I mean by roll, right, is that I will buy back this position. Okay, so let's look down below here. What I'll do is, let's say I sell a 145 and I bought a 140 to make a spread, right? Oh, sorry, you all cannot see. Okay, right. So I sell a 145, buy a 140 to make a spread. What I'll do is then when I close it, I will just buy back this one. Okay, and then I will sell the 140. Then when I roll, I will re-establish the spread again. Right. So I wouldn't want to do like a half roll. Like, some people like to, just close the sell put, because usually what happens is that as it goes down, the sell put will be losing more money. Right. So the inclination for people to do is I'll just close the sell put and then later on I will do something else. It's very complicated and it makes it harder for you to calculate your P&L. I like it very clean. Right. Once the DTE drops to about 2021, I will just close this whole thing. Then I'll re-establish, I'll reset it. Right. So I wouldn't make it complicated. Leave it like half like that. Okay. All right. Okay. Come. Let's continue here. So okay, let me take put down Celine's question first. Okay, come. All right. So a few rules that I set for myself on how to be a good spread trader. So I just want to share this with you guys, and I hope that it's useful so that everyone here, right, during this period of Donald Trump tariff, right, or I call it the Trump dump, okay, because Trump comes on, right, everybody dump the shares, okay. How do you still make a good profit out of this? How do you still consistently make premium? Okay. Number one is that recognize that you will have losers and winners in your trading. Okay. Don't think that, wow, every time I trade, it must be a profit. No, there will be sometimes you will lose, but generally, because we are setting it at a support and quite far away, right? My personal track record that I can see is that this has a win rate of closer to about 70%. Okay, right? So the important thing is keep your losers small. That means the moment you hit your stop loss target, right? So for example, you hit your 20 days, right, or be chopped down, please don't continue the mistake already. Okay, just let it be. And in fact, every time you do a spread, your max loss, let's say, is $5, right? Then your max loss is $500. Okay, so just understand that each time you do, the margin is 500. Right. So this trading system, in a way, I feel that is very good because it is already pre-capped how much you can lose. You cannot lose more than this. Even if you forget to manage the trade, the worst outcome is just this $500. Okay, right? And try to make sure that you're not trading a $1,000 account. Okay, right? And you're trading $500, then that's a lot, right? But if you're trading like a bigger account, right? Like let's say you are trading like a 50K account, then you're doing $500. That's like 1%. Right? So that is quite reasonable. Usually I'm looking at about between 2% per trade, something like that. Okay? Right? So please that brings me to my third point. Position size your trade accordingly, right? Of course, if you are of a higher risk appetite, you want to set a higher percentage each trade, is really up to you. But for me, I like to set it about 2%, right? Plus minus around there. I don't like to go above 2% because 2% has been statistically shown that there's a very, very low chance of you wiping out your account, right? And to me, survivorship is the most important here. Okay, all right. So personally, I put that, I limit my each trade to less than 2% of my whole portfolio. Okay, and remember, when you're trading, you need what do you call it? You need numbers. That means you need a higher number of trade behind you, right? So that your trade results can show. Okay, so if you only do like 10 trades, right? Don't expect that our Pete say 70%, so much is 7 trades out of 10 trades. No, it may not be, because it could be like you are only doing 5 profitable, because the sample count is too low already, right? But if you do like, let's say 1,000 trades, then I think your profitability number will be closer to 700, maybe 672 or something like that, right? So make sure that you have a higher sample count. That means you need to do more trades. Okay, you need to do more trades as well, right? And that is also helpful for new beginners to get a hang of like, okay, this is the set of parameters that I learned from Pete, but what is the parameter that truly suits me? You need to explore that and find out yourself. Okay. All right. And lastly, guys, please don't be greedy when you have a winning streak. Okay. Right. There will be sometimes like, wow, I've been doing spreads. My last 20 spreads all make money, right? Then just when you feel very confident, what will you do? You want to increase your position size, right? So instead of risking $500, some people will say, oh, now I'm going to do $1,000 per trade. Okay, right? And that's when you're getting greedy, right? Then that's when the market will punish you. Okay, so please don't be greedy when you have a winning streak, right? Don't go like, oh, no, change your position sizing. Keep it there. Just make sure you're going for a higher trade count, right? To me, that is the most important here. Okay, all right. So how do you make sure that you are doing it correctly, right? So number one, so this is the mobile platform. I know just now I showed you all the desktop, but I also want to show you the mobile platform, right? So on the mobile platform, you can also see the expiry date here, right? And also the strike price here, okay? But more importantly to me, when you're doing a spread, right, always look at, okay, what is my max profit, right? Or what is my max loss? And if for those of you who are doing single-legged, let's say you're just selling puts, right? Or you do you do one sell put already, all right, and then you do a buy put separately, right? What you can actually do is to set a stop limit, right? So that if the share price drop or the premium drop below a certain number, right? Okay, you can get out of the position. So sometimes when I say don't be greedy, right, it's a bit hard to do it by yourself, right? So what you can do is use different conditional orders over here, right, to protect yourself. Okay, I wouldn't have the time to go through all this, but basically what you can usually use is just a stop limit. That means, let's say you sell one put, the premium is, let's say, $5, okay, right? Now, when you sell put, you actually want the premium to go down to 0 because it expires worthless. But you can actually do a stop limit, say when the premium goes up to maybe 7.5, right? Why 7.5? Because it's 50%, right? Then you will close the position because you know that something is wrong already. Okay, so but let me just emphasize for Mumu, this stop limit currently only works for single options. But if you enter a pair of trades for spreads, then there's no there's no stop limit, right? Because it really doesn't make sense. Your limit, your limit of loss is already $500, right? Then you go and put stop limit somewhere, it's a bit funny. Okay, so I understand what the brokerage wants to do here is to protect the single leg where the loss can be much higher, right? Can be unlimited in this case. Okay, Vincent asked a question. What if the price at mid of buy put and sell put? What do you mean? What do you mean? It's usually not in the middle of. Oh, you mean the current market price, is it? Okay, so let me just elaborate again. Okay, so which slide should I go to? Maybe this slide. Okay, so now the share price is about 100 and okay, I don't know 150 lah. Okay, let me just erase all this first. Easier to see. Okay, it's 150, right? Let's say the support is about 140. So when it's 140, I have to make the spread across the support. So maybe 143, then maybe 138, something like that. Okay, right? If I want to do a $5 spread. Now, can you do a $10 spread? Yes. Okay, you can. But just remember, for every $5 spread, I'm asking for a $1 premium. So if you're doing a $10 spread, okay, then you are asked, I will personally ask for a $2 premium. Okay, now for $10 spread, it means what? You are risking 1K. So just remember, the bigger the spread, the more at risk, right? So don't be greedy. Sometimes people see, wow, hey, the premium very good if I increase the spread. No. When you increase the spread, your risk also go up. Okay, so just take note of that. All right. Let's see over here. Okay, any questions? Okay. Over here. Okay, so yeah. So maybe you want to take this slide, write down this slide, or take a picture or screenshot if you want to use it. Okay, I clean out everything for you all first. Okay, I have my picture so you can see. Okay, all right. Okay. All right, so that is basically how I use bull put spread. Because right now, while the market is very volatile, right, what I like to do is just put it very far away, right? So for example, you can even do it on other things like, let's say you're not very familiar with individual stocks, okay? And over here, oh, I realize you cannot see the top when I do this, right? Okay, so let me shift it down. Can I shift it down? Let's see. Where should I bring it down? Okay. Okay, I bring it down. Okay, here. So you can see. So if you're not familiar with individual stocks, okay, then what else can you do bull put spread on? You can actually just do it on simple stuff, like S&P 500. Okay, you can actually go to SPY, right? So this is SPY. And I also personally like to do spreads on index because actually index move a bit slower than individual stocks, right? So that is the advantage over here. So let's say right now is about 564, something like that, right? So what I will do is, okay, let me just draw, right? Maybe I'll find the support, which is the recent one over here, right? So this is about 555, right? So maybe I'll do somewhere in between. So maybe like 560 to about maybe 555, something like that, right? Or I want to be safer, I can do 555 to 550. Okay, so let's take a look, right? So over here, okay, once again, I'll choose roughly. Okay, so you can see there are a lot more options here, right? So I'll choose 43 first, right? Okay, so I will do 560, right, to 555. Okay, so you can see the premium is very, very good, right? It's way above what I need for $1. This is like 150 already. Okay, so you feel that 150 is a lot, right? Then what can you do? Okay, it's either you can take this premium because you are quite confident about the share price that you put, or what you can do is just shift it down some more. Shift it down some more. Okay, so how to shift? Very simple. Don't take 560 okay? Take 555, sell 555, then you buy at 550. Can you see that? I sell 555, okay? Then I buy 550, right? So you see when I put at the bid price here, it says create a sell order. Right? So Moomoo makes it very simple that you won't make a mistake. Okay? Then you put at the ask price, right? It says, okay, create a buy order. And in fact, once you click already, it will appear at the bottom here. Okay? All right? So this is what you can see. Right? I'm selling 555, I buy 550. And what is my premium that I'm collecting? Still about 139, right? Just now I'm calling 150, right? And this here I'm going 140. But in this case, I'm a lot safer. Why? Because now my spread is much further than 560. Okay. So if you feel that, hey, wow, this is still very, very close, you want to go even further, can or not? Can. By all means, just go and make it lower, make it even lower if you want, right? No problem over here. Okay. If you want to make it lower, you can choose like maybe start from 550, then go down to 545. No worries. Also can. Right? Okay. Okay, let's see. So in fact, I choose already, right? Let's say I choose already, go back to the curve, right? You can see this is your P&L diagram, right? So over here, actually, the win-loss is actually much better because last time is 500 you put at risk, then you make 100, right? Now you only put in like risk at 360, then you make 130. So it's almost like maybe less than 3:1 already. Yeah, right? So the higher the expected returns, the better it is, right? And you are putting quite far away. Okay, so any ETF with put options, you can do this. But of course, what you want to do is choose those with higher volume, right? So in this case, you can see over here for SPY, its volume is very, very high, 1 million plus, right? So there's no worries of like, oh, my option didn't go through and things like that, right? It will never happen. Okay, unless you bargain too much, but otherwise it will almost never happen. All right. Okay, let me go back to the slide here. Okay, any other questions? Wait. Let me go back to the slide. Okay, so how do we sign up for Moomoo? Okay, so let me bring up the Moomoo offer. Okay, so right now, for those of you who have not had the Moomoo brokerage yet, okay, so this is your first time, right? Actually, they have a quite good sign up bonus, right? So depending on how much you fund, right? Let's say you fund like maybe 10,000, they will already give you $150 of Tesla voucher and $150 of trading voucher. Cash coupon. So that's $300 already. Okay. Wow, not bad, right? Like 3% ROI straight away. Okay. And if you deposit up to 100K, then you get about $820 worth, right? Both Tesla shares and also trading cash coupon. And on top of that, for those of you who use my link, you also get an extra $20 over here, right? So that will bring your y'all cannot see, right? Let me just adjust. How should I do this? Let me see. Like that. Okay, right? So you will also get an extra $20, right? From the 820. Okay. Over here, anything you see here, if you sign with my link, you get extra $20. Right. So this is just the bonus that Moomoo has brought to the table for my community. Okay. All right. So what's the link? Okay, I put the link here. The link is here. rebrand.ly / Pete Moomoo. Easy to remember now. Okay. Okay, is Moomoo in Hong Kong? I believe so. Okay. If not, you can just try to sign up for the account and see what they'll redirect you if you are from a different location. I think they'll redirect you. Okay. Okay. So I got the QR code here and the link over here. If you want to just scan it or just type the link in the chat, I think that might be easier for you guys. Okay. All right. Okay. So that's all I wanted to share with you guys in terms of credit spread. Right. So just remember the basic rules. Right. Which is making sure that you're not greedy. For every $5 spread, you're asking for $1. And the time, the DTE, right, is between about my personal preference is about 40 days plus minus. 50 days also okay, right? But 40 days is the one that I still managed to do quite well. Okay, right? How about existing Moomoo holder? Okay, so I got good news for those of you who are existing Moomoo holder. So let's see if I can bring it up here. I don't know if I can see it from here. Give me a second. So basically, Moomoo has this thing whereby they don't charge you for options. Okay. Where is it? Okay. I don't have it here, but if someone has the link, you can also send. But basically, what happens is that when you go into the maybe I have it in my here. Let me see. Do I have it here? Okay, I don't think I have it here, but basically what you will see is that when you go into your Moomoo account, so long you per month, right, you do one trade, they will give you $70 worth, right, of commission coupon that you can use to offset the rest of your trade that month, right? So actually that is the benefit. For those of you who already have an account, you can actually get almost free commission. You don't need to pay the Moomoo commission, right? Because they give you $70. And I don't think you all trade that much. Okay. So essentially what will happen is that because it's 70 cents commission, right? So your first 100 trade technically is free. Once you do your first trade, then your next 100 trade is free. I would say free. There are some other fees to pay, but the Moomoo part of the fee is compensated by the $70 voucher. Yeah, right. So that I think applies to everyone. Doesn't matter. That's why they put limited time, because I don't know how long they're going to do this, right? Because they are actually not making. Can I say this? Okay, but they are actually not making much money now when they give you all like free commission, right? Because the rest of the fee that they need to pay are the SEC fees and whatnot. Yeah. Okay. Okay. Vincent has a question. Let's see. When you sell a put, there is a spread between the buy and the sell. Do you normally queue? Okay, great. So what Vincent is asking is that usually when you sell anything or buy anything, right? Or let's say you sell put option in this case, right? There will be a bid price, okay, and an asking price, okay? Now, what I will do is I will choose somewhere in the middle, okay? the question that Vincent also asked is, do you normally queue? Now, for those of you who are not aware, the queuing means, let's say the bid price and the ask price is like that. Okay, so I'm gonna give you some numbers. So let's say it is between $1 to 120. Okay, this is a very big spread, by the way. Usually it's not so big one. Okay, then the middle will be around $1.10. Okay, now what he meant is that, will I just put it at the ask price and hopefully I will sell it at 120 instead of 110? Okay, and my answer is no, I don't. Okay, now why is that the case? Because I don't want to go and quibble these $10, right? Of premium, and then end up, right? Maybe what if the market never come to the asking price, right? And my trade never go through. Okay, so just remember, as a trader, to me, there are a few things that's very important. One is that you must have sufficient experience. That means you need to trade a significant number of times, right, in order to figure out what works best for you. So for every trade that you cannot do, that you have already thought through the entry plan, the exit plan that we did just now, right, is a wasted opportunity, right? So that's what I don't like, lah. Okay, so I don't want to waste any opportunity. So that's what I don't like. Number two is that it is only $10 difference, right? So it's not going to make a big difference, right, in the grander scheme of things, because this is just one trade out of my, let's say, 1,000 trade. Okay, so it doesn't matter to me. Okay, very good. Good question. Okay. All right. Yeah, so correct. So Vincent's next point is, or just take whatever is in the middle. Yes. My answer is I'll just take whatever's in the middle. Okay. All right. Okay. So fantastic, right? I hope this is useful for you guys. I hope you all really learned a lot from this session, right? This is basically the first part of the option series, right? Next week I will touch on even more options, going more in depth, right, beyond what I teach here in terms of credit spreads. Okay, so for those of you who wants to learn more, right, do watch out for the next week's Invest with Pete, right, option series. I'm going to do this into a series. I don't know how many weeks, I don't know how many topics I can talk about actually, right, but I want to share as much as possible in terms of education, right? Because in the Stock Market Genius community, what I do is I just teach more advanced already, right? But I realize actually a lot of people, right, maybe they are still very new, right? They are not familiar with options, and therefore they kind of hinder them in the progress, right, of investing. Okay, so in a way, I want to share the basic stuff as much as I can. Okay, and I hope that for those of you who are new, this is not too daunting, right? But I can assure you, once you get started, right, actually options is one of the best thing that I've personally experienced in terms of investing, because you can control your risk, right? Like today, you control your risk to $500. So no matter what happens, you will lose more than $500. But in the other form of investing, let's say you're just buying shares, you might lose a lot as well. Okay. And one important thing is, when you are trading and investing, also make sure that you have the good instruments, good tools to use. And one of the tools that I personally use is actually the Moomoo platform, right? Because one thing I didn't realize before this, right, is that actually I didn't realize that their desktop version, right, is so powerful. The desktop version is very powerful, no? So for example, right, let's say I go to, let's say, Amazon, okay, right? Wow, I can see what are the options available, right? I can see what are the ETF that's out there that is done for Amazon. I can check out the financials, right? And I can check out the revenue breakdown, where the money come from, right? And stuff like that. I can even check valuations, right? So they even have like the Morningstar rating free for you, So this one usually need to pay one to go and see, right? But they have done everything for you already. Quite cool, right? Quite cool. I didn't realize that they had all this on the platform, right? And they even give you like different institution, right? What is their rating? Is it a downgrade, upgrade, or whatever? Although to be very honest, I don't look at this personally, but it is good to have all this at your fingertip, right? And also any dividend coming, stock split, right? So you can even see like, oh, back in 2022, it was a 1-20 stock split, right? So otherwise, Amazon today will be a lot more expensive per share price, okay, right? And also, who are the shareholders, right? Who are the major shareholders? You can see that here, Jeff Bezos is a 8% shareholder, right? The new CEO, actually, he doesn't have a lot of shares, right? So I don't know why. Okay, I hope he go and buy more shares later on. Okay, but more importantly, you can also see what are the insider activity, who has sold, who has bought, right? How much they buy, how much they sell, all this, right? So on one platform, you can have at your fingertips almost everything you need, right? Which is quite cool. Yeah, then there's a profile, that's simple one. Okay, so this is something that I like a lot, right? And of course, you can also do your own watch list, and make sure how to monitor them and all this, right? So tonight we are having a good day, right? Everything is up, especially anything related to Bitcoin. Can you see that? Wow, MSTR is up 3%, Coinbase up 3%, IB is up 3%. Wow, everything is up 3%. No? Right. So yeah, so for those of you who have been following me for a while, I also mentioned many times Bitcoin is one of my investment, right? I just wanted to give a disclosure. To me, Bitcoin is like gold, digital gold. So I own physical gold, I also own digital gold. So I doesn't matter which one succeed in the end. At the end of the day, I still benefit. Okay. All right. Okay. I know I talked a lot already. It's 10 o'clock already. I don't want to hold you guys back. Just watch out for the next week's session. I will share more about what are the other option strategy I do, not just to earn passive income like spreads in this case, but to also exponentially increase the portfolio, especially right now with the market recovering. Okay, what are certain option strategy that we can consider to help us to build our portfolio? What are some of the strategies that I'm also using in my exclusive community, the Stock Market Genius community, right? For those of you who are in SMG, you know that we started to do some options buying already, right? So in the next week, right, I'll talk about how to buy options and how to use that to help you to increase your portfolio profits as well. Okay. And once again, for those of you who haven't had a Moomoo account, right, this is one of the very powerful platform that you can have both on your mobile and your desktop, right? The link is over here, reblend.ly/PeteMoomoo. Okay. And you can get, for using my link, right, other than the standard normal promo out there, right, you can get an extra $20, okay, that you can add to your trading as well. Okay. If not, that's all I have for you guys this session, and I'll see you next week. Okay. Bye bye.